Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Ramsey, how are you?
Fantastic.
Good. I had a great trip with Mark Fitzgerald down to the Medicarians Conference in Las Vegas last week. We had some great conversations. I think you heard a few of them.
I listened to all the ones you sent me. Really fantastic conversations and some real hitters you managed to get on the podcast with you. It's fantastic.
Yeah, no, it was great conversations, and we'll release them a little later this summer. But just a superb conference that Jane Weintraub put on, and it was actually a really good intersection between companies in the senior healthcare market, startups, and traditional distribution, and kind of that actually is going to be kind of a zone we're talking about today. And I'll start with we're going to be talking about homes. Homes are such an important asset class for most retirees. For typical people retiring, Social Security and home equity are probably the two biggest assets they've got to work with and use for income in later years. Now, how do you convert that home into retirement income? Probably the most common strategy is downsize. Sell your house. Take the proceeds, move somewhere smaller, cheaper, tax rates are lower, and you freed up this equity. I mean, that's an expensive, very disruptive way to solve that problem. We've had Ramsey, your friend Don Graves, on several times talking to us about HECM loans, reverse mortgages, as a potential solution. Today, we have David Shapiro, who is founder and CEO of EquiFi Corporation, to talk about another approach to David, I'm going to say non-disruptively allow retirees to tap into their value of their home to provide a stable income in retirement. So welcome to our show, David.
Well, thank you. It's great to be here.
Yes, and you actually this is actually a startup company that we're going to talk about today, correct?
Yeah. We're an aging startup because we started in 2016, but because of the way that we're coming to market, the regulatory piece of the business takes an exceedingly long period of time. So, but yeah, we launched in late January, early February. But yeah.
Interesting. All right. Well, tell us about your company and tell us about the product that you're offering.
Sure. So what led me to this was, a career in the annuity space, basically designing annuities for insurance companies, training stockbrokers back in the old days and financial planners on how important it is to save for retirement. And, I built a company called Info1 that was the first SaaS model that had every variable annuity on our platform. It was all cloud-based back in 1997, 1998, when Bill Gates was talking about the internet. And so we built this ecosystem around annuities, and it allowed advisors to look at all the annuities on the product, illustrate them, screen scrape in their clients' data, and trade it. It would go through Pershing or DTCC or the whatever firm there was the clearing firm. And EquiFi is fundamentally using the exact same ecosystem, but it's focused, as you said, Paul, primarily on the baby boomers that want to retire in place. And as you said, the home is, the average American has 70 to 75% of their wealth is in their home. And so being able to give people access to that in a form that isn't debt, that doesn't have a current interest rate, doesn't have an accrued interest rate, provides them the flexibility to stay in their home the rest of their lives, was the gating factor for me to create EquiFi, which we did in 2016. And we're organized as a Delaware Public Benefit Corporation. So our intent is to help people create wealth and manage the wealth that they have in the most important asset that they own, which is their home. And that's kind of what led us to this journey. And the product is purely a trade between a homeowner that has equity in their home, wants to access that equity, doesn't want to have it in the form of a loan, and there's an investor on the other side that says, hey, I'd love to get some exposure to home price appreciation. And if I can be a silent investor with the homeowner and just take the ride on the appreciated value of the home, then that's a great deal for us. So it's designed to be a very fair trade between a homeowner and an investor that allows both parties to feel that, they've entered into an agreement that they both can live with, and it provides the benefits to both. And in the middle of that is the distribution of the product, and we exclusively provide the product through financial advisors, insurance agents, mortgage brokers, folks like that already have a trusted relationship with the consumer.
So can you talk a little bit about what the actual transaction looks like? What is it? So T0 starting point. I'm 70 years old and I own my house, and then I enter into a transaction with EquiFi, and T plus a week later, or however long it takes, I've now entered into an EquiFi contract. What's different? What do I have? I still own my house.
Yep, you still own your house.
And so how much of my house would I typically own? Like, how much would EquiFi or EquiFi's investors, what percentage of a house would you typically purchase in one of these transactions?
Yeah, we can go up to 35% of the value of the home, sometimes a little bit more than 35%. So let's just take an example. Let's say you've got $1 million home, and for purposes of this, since 37% of the homes in the country have no mortgage, let's assume that there's no mortgage on the home. So we've got $1 million home. Let's say the homeowner wants to get $400,000 out of their home. Let's max it out and say we can give them 40%, right? So we basically advance them 40% of the value of their home. And then since the home has got a value of $1 million, we put in $300,000 of what we call protected equity that sits on top of the $400,000 that we put in. And then when the homeowner dies, sells the property, or chooses to prepay, for that 40%, they're going to give us, half of the value of the home above their protected equity. So the home's $1 million. We put up $400,000. There's $300,000 that we don't share in at all. And then anything above that, plus the appreciation in the home, we would take 50% and they would take 50%. If it was a $300,000 instead of a $400,000, which is 30%, we would probably take 38%, and they'd have $400,000 in protected equity. So that's and it plays out very nicely in pictures.
I was going to say that is a transaction that definitely would benefit from an illustration, or
yes.
A picture, so you can understand sort of what the parts are, like what exactly the terms are for the protected equity, et cetera. But fundamentally, so let's just stick with sort of like the general outcome. So once I've engaged in this transaction with you, like how is it different than a typical reverse mortgage? Why am I as the consumer, why am I in a better position?
Yeah, so I think the better question is based on each individual, right? So we don't necessarily believe that there's a right or a wrong. So I think that if you're an advisor and you're working with a client of yours that is in this position, you should be presenting them a HELOC. You can't really, with FINRA, a registered rep can't recommend a HELOC because of the FINRA restrictions on you utilizing home equity, particularly if you're going to be utilizing that to buy a security. But they should make them aware of their options. One would be a HELOC. Paul, you started that with they could sell their home, right, and relocate and get a smaller place. The reverse mortgage presents a different opportunity because it doesn't have a current interest rate. It has an accrued interest rate. And you can't be on a HECM mortgage, which is the most popular government guaranteed reverse mortgage. You can't have a first mortgage. So one differential between us and a reverse mortgage is if somebody has a mortgage on their home and it's at a 4% or 3%, they may not want to pay that off just to get the reverse mortgage, which today is going to be starting at probably a 6.5%, adjustable rate interest. So that's one of the things that they need to consider. And then the thing I think that most differentiates us is that our market with aging baby boomers, the older people get, they don't want a mortgage. They don't want to have, a current payment. They don't want to see a accruing interest rate where every statement that they get, the payment, the balance is going up and up and up. It's not going to ever go down. So I think that, that's a real limitation. And, frankly, the other issue with reverse mortgages is that, there's a cost to our product. There's a cost to a reverse mortgage. There's a cost to a HELOC. With reverse mortgages and with HELOCs, a lot of that cost is built into the spread on the interest rate. But just the upfront costs, we were looking at a comparison. One of our financial planners, RIAs in Sacramento, has a client that wants to use our product, and the apples to apples comparison to get, $400,000 out of their home, the reverse mortgage, just the cost to originate it was $28,000. Our product was $12,000, so much more expensive up front. And then the other issue with reverse mortgages is that you don't know what the liability to the estate is going to be. So with our product, exactly if we're putting up that 40%, which is a lot, right? And we're going to take half of the net equity in the home, upon their death or sale, whatever. They know that 50% of their home can be managed in the estate. Where with a reverse mortgage, you just don't know what that balance is going to be, until there is. So for financial planning purposes, it's a difference that we think, helps our cause in, setting that comparison up. And then reputationally, I don't want to malign the reverse mortgage industry, but there is a historical a legacy fear of reverse mortgages that built very early in the industry. And so, you have to deal with that generationally as well, because a lot of the baby boomers had parents of theirs that, looked at a reverse mortgage and felt that it was not appropriate for them. So the reverse mortgage industry has some baggage that they have to deal with historically.
Yeah, well, and you kind of alluded to this earlier, which is when people say, "Is this a good product or bad product?" Well, it always starts with the two words: "It depends."
Yeah.
Now, if my goal, Ramsey, I'm thinking if I'm going to do one of these things, right? I think there are two goals I have. Challenge me on the question, because maybe I'm not thinking this way. One is I want to maximize my income available for my house, and two, leave something, probably, as much as I possibly can to my survivors. So I think I have two goals. Now, David, I can see two different scenarios taking place here. One is, let's say T0, Ramsey, housing market it's indexed at 100. By the time I pass on, it's now 235, of what it was, prior. Huge appreciation. Mm-hmm. One scenario. Other scenarios, it was pretty flat market. We only had a slight appreciation. David, how do how would these instruments perform? Reverse mortgage versus what you're doing. If those are my two goals, maximize income, maximize what I'm leaving.
Yeah. Well, and the two factors that you have to take into account are what's the forward-looking interest rate over time versus what's the home appreciation over time. And I mean, that's an unknown that, each person's going to have to answer for themselves. So I think it is a financial decision. But there are other elements, like just not wanting to have a mortgage or the whole estate thing. But it is a financial equation that it's not perfect, because we can't see that far into the future. And that's one of the reasons that that I think that reverse mortgages, most of them are on an adjustable rate because the way that they're structured, with HECMs, you really can't get a lot out if you're doing a lump sum and a fixed interest rate. You can get very little out of your home. So most of the reverse mortgages are variable rate, and that adds a unknown that's hard to quantify. Ours is fully quantified, but you're right, Paul. If home prices appreciated higher than we assume in our illustrations, then the investor, but they're in lockstep, right? The investor and the homeowner are sharing that in lockstep. So I think that's probably the safest way to look at it without being able to know what the future is going to be like.
I mean, it just highlights, there are different complexities for each of these solutions. I mean, they have very different risk profiles.
Yes.
And that's at the heart of your question, Paul. In an environment where home prices are flat to down and interest rates are spiking, then the HECM loan is kind of a tough call, right?
Right.
In an environment where home prices are expanding dramatically and interest rates are low, then HECM may be the better one. I mean, in some sense, you got to do. I don't know if you do a Monte Carlo analysis, but
yeah.
It seems to me like a fiduciary advisor, as they're thinking about providing a menu to their customers, in addition to sort of factoring in those preferences that you were talking about, David, which is I want something that's a loan versus an equity share, like that.
Yeah.
That decision, which may be is much sort of a personal preference thing. In addition to this notion of, well, what is the risk profile I want to have vis-a-vis this house, over the course of the next 10 or 15, 20 years. So it's, look, I think there need to be more answers. Like I think you need to have more ways to sort of, peel this onion effectively. So I think it's you're bringing another practical solution, which is very interesting. Now, I had a question about, costs, about maintenance costs. So one of the other things that I often seems to sort of not get discussed enough, and where I think sometimes people get into trouble, with their homes, is that when they get a reverse mortgage, is they take money out, right, which is great, but sometimes property taxes and other sort of maintenance costs end up being the problem that comes up. So under your construct, do homeowners still bear all of those maintenance and property tax costs, et cetera, or is there any sharing of that?
No, because we don't go on title. We're not owners of the home, so they pay the property taxes. They pay their insurance. We do have provisions where we can step in, and if they fall behind, we can make what we call preservation payments, and then we just tack those on to the back end. And they are required to just maintain the home. It doesn't require them to improve the home. So if the home is in disrepair and they haven't improved it, then there is an adjustment at the back end, to take into account the cost of making that home, updating whatever maintenance that needs to be done, that gets factored in. But that's kind of the only way that we can attack that.
So another item that we talked about sort of leading up to this conversation was who you're going to fund this. So the entire mortgage industry, or also sort of like, I'll call it the mortgage equivalent industry, ultimately is funded by pools of assets. It can be insurance companies, it can be institutional investors. In some cases, it's venture capitalists, it's pension funds, sovereign wealth funds, and you had mentioned that you're building a product that you think is particularly interesting to sort of one set of investors. So can you tell us about that? Yeah,
our product is specifically designed to meet the needs of both the investor and the homeowner, and our targeted investor long term are insurance companies to hold this on their balance sheet and their rated security. So when we designed our product, and you'll note that in the example, there's 30% equity on top, right? That there's 30% equity in the home. We needed to have that 30% cushion because when the rating agencies stress this asset, the asset-backed security, the first thing they do is take an overnight drop in home prices of 30%. And then they look at a 8 to 12 year recovery. So for us to get a rated security, we needed to have that 30%. And that's one of the reasons that we have that piece of the equity in there. And, eventually, when we create these asset-backed securities, insurance companies will be able to hold those in the kinds of volume that we need to be able to meet the demand from the consumer. I mean, the residential homes in the country are closing in on $40 trillion, $38 trillion. There's $20 trillion or $26 trillion now of equity in homes. So the massive scale of this, and you consider the fact that we're only working through financial advisors and folks that have a trusted relationship, and they're integrating the home into the financial planning process. We have to have significant capital to come into the market, and the securitization's the only way to do that. And that, you guys know, that takes a long time. I was fortunate enough back in 2017 to spend an hour and a half with Lou Ranieri, who created the mortgage-backed securities. And I have to admit that when I designed this product initially, I designed it in 2005. So I had my first share equity company back in 2005, which was, well before the housing crisis. And Nationwide Ventures was an investor. Oppenheimer funds were investors. And, then Morgan Stanley was going to securitize the asset. And then the housing crisis came. So I'm sitting with Lou in 2017, and I said, I'm just curious, how long did it take before the first mortgage-backed security? How long did it take you to get from concept to the security? And he said 12 years. And I said, wow. So I said, okay, well, I'm about in that ballpark. So I don't know. I'm not going to feel bad about that. It does take time, but I think now we are within a year, maybe a little less than that, 3/4 of a year to get a rated security out. And there have been 3 securitizations of our competitors' products. They haven't been rated, nor can they be rated. The design of our competitors' products don't allow for securitization. Either they have a 10-year term on them that's problematic to the rating agencies, or they're based on home price appreciation, and a shock loss, would blow it out. So we feel that we're perfectly positioned to be the leaders in a rated security. And that's why we're working primarily with insurance companies and with hedge funds that are private equity funds that own insurance companies, because they're the best partners for us to achieve that.
Yeah, well, capital charges can be very consequential, as you know. We, at a prior company, we put a lot of effort into trying to partner with a company doing, stepping in and providing jumbo reverse mortgages, right? Non-HECM loans, and the yield looked great, compared to Ramsey investing in vanilla corporate bonds. The challenge, though, David, was the capital charge, and I can't remember what the rating was that we were determined, but it was enough to sort of like take the yield down below, quickly below corporate bonds. Do you have any indication that you'll end up you'll be rated higher on the NAIC scale than sort of a reverse mortgage sitting on an insurance balance sheet?
Well, are you talking about a scenario where the insurance company, so that's a jumbo, so they would be holding those on their balance sheet. Those aren't securitized, right? They were just holding them on their balance
securitized.
Sheet. Yeah,
right.
So the surplus strain for that was probably 15%.
Yeah,
right?
That sounds about right.
Yeah. And so that's problematic. With the asset-backed security, we think that we're going to get a senior A at a single A or a triple B at the worst. So it's a whole different, it's an NAIC 1, it's an NAIC 2. It's the surplus strain is going to be a lot less.
So who holds the rest of it? So you've got the senior tranche is what the insurance companies are going to buy. Yeah. And then you're going to have, lower tranches, and I guess maybe like an equity tranche or something equivalent. I'm sort of thinking of it in the framework of a collateralized debt obligation.
Yeah, exactly.
Who's going to retain the, all the risk, all the riskier tranches, do you think? Or who do you see as target audience for those?
Well, that's where I think the hedge funds come in. The hedge funds come in. Insurance companies that have other arms, a lot of insurance companies want to buy the AB vertical. And then you've got the equity tranche, which is, when we do them, we'll be holding the equity tranche. So, but lots of interest in the A and the B.
Interesting.
So, by the way, I think I want to circle back to your description of the structure earlier on, because I think it took me a while, but I think I got it right. So let's go back to the example of it's a $1 million loan, right? And your organization puts up 40%, so you give $400,000 to the participant, right? So if let's use two scenarios. One scenario is the value of the house doubles over the course of the ensuing years. So it goes to $2 million. So then you will then get back, if I'm correct, you'll get back your original $400,000 plus 50% of the price appreciation. So EquiFi would get $900,000 back in that scenario. Is that?
Well,
right?
no. So think of it as the house sells, right? So we know what the ending value of the house is.
Yeah.
And then the closing statement's the easiest way to look at that. So the closing statement, we get back our 4.
Yep.
The homeowner gets 300, right? Because they're protected equity we don't share in, and anything above that is split 50-50.
Okay. So even though it was $1 million, it was $1 million house, but of the original principal amount, you will have a claim on $700,000 worth then.
Nope.
Well, no, it'd be the appreciation, right? So tell me if I'm getting it right. So the $1 million house goes to $2 million, Ramsey. See if I'm understanding this.
Yeah.
So you keep $300,000, David. You split 50-50 of the million that went up. Is that right? So you would get $500,000. Is that right, or am I wrong here? See how if I understood this?
That's what that was my original version. So that's
okay.
That's $900,000 on the upside in the upside scenario.
Yeah,
but it sounds like it's more complicated than that.
No, it's no. So all right. So the math isn't. I'll turn it over to my CIO at some point in time.
No
He's a lot
worries.
better at that. So so it went from what, 1 million to 2 million?
1 million to 2 million.
1 million to 2 million.
Okay. All right.
They got $400,000 up front.
Yep.
And now there's a $1 million gain. So in my view, as I understand it, the $1 million gain is split 50-50 between you and the homeowner, right?
So the 2 million's now down to 1.6 after we get our money back, right?
Okay.
And then 300 goes to the homeowner, so we're down to 1.1.
Okay.
And that's what's split.
Okay. All right. So we're close. We're close. Yeah. So that is potentially right. This is where potentially it super rising home environment, Ramsey. Maybe I go with the HECM, right? If my goal is to leave money that I will never see, to my kids.
Yeah. I think that the way we look at it is we just look at historical. We look at look back on 20 years of home price appreciation. The last 5 years are going to level out, and who knows what's going to happen in the future. But I mean, that's the best way for us to analyze anything is look at where interest rates have been, look at where home price appreciation has been, and then, take our own view of what the forward looking is.
Okay, well, maybe let's just stick there in the last few minutes we have about, forward-looking view of housing. Now, I don't judge me on the source, but I'm looking at headline is, Ramsey, you can tell me what news source this is. Property prices plunge by up to 20% across parts of U.S. as buyers shun the market amid Biden inflation and spiking interest rates. Okay, Ramsey, that was Daily Mail. In case you...
I was going to say, clearly a conservative news source.
Yeah. But, so David, what's the outlook? Is this, we've had this huge rise off of, pandemic, everything about low interest rates, everybody moving out of the city now, inflation comes up. What's if we're going to invest in your enterprise, how do you look at the housing market over the next, 10, 20 years?
Sure. And for our investors, they don't really care about the next 3 years. They're looking out. We expect that the average duration on any one FE is going to be, 8 to 12 years, something like that, right? So, and that's why it's so good for insurance companies. It's a great long asset to put on their balance sheets to match up against annuity liabilities, life liabilities. It's perfect for them. So when you look out, I don't think that there's going to be this huge bubble that's going to burst. I think that we're going to go from, 18 and 20% crazy home price appreciation down to, 2, 3, 4. I mean, we track that data every quarter. We get updated forward-looking views on home price appreciation. And what we've seen, the trend over the last 2 quarters is that the urban areas are still holding at very solid forward-looking HPAs. Like we cap our assumption at 4%, but what we're finding is there's still areas that are 6, 8, whatever. The rural areas are the areas that have softened, and they've dropped, anywhere from 0.5% to 1.5%, and we're just seeing the flight that the pandemic led to people getting out of the city. Most of those people are gone, and the rural areas are the ones that are suffering right now. But long term, I think it's going to normalize. And investors in our product, I don't think are they care a little bit about the short term, but they really are looking for long term returns, long term investments.
Interesting. Now here's a curveball. So our mutual acquaintance Ken Judquist is going to come up to a forum we have next week, and one of the panels discussion is on climate and what that means for retirement. So climate and housing. I just watched this house get washed away in Yellowstone, right?
Yeah.
With the flooding. How are you going to approach and look at values of homes in areas that may be impacted by climate? It may not just be coastal areas, right? It's
Yeah.
Middle Mountains, Rybrook, New York, where I am, right? It's
Yeah. The answer is the question is not one that we're going to answer because it's the investor, right? So, when we talk to investors and to finance our product, we can't use warehouse financing because there's no interest rate on our product, right? There's no cash flows on the product. So we work with forward flow agreements, which is a financing where an investor advances us the money to fund the equity, and then we sell that asset back to them. So, we can provide them guidance, but they're the ones, like there's one insurance company that, just is scared to death that California is going to burn and doesn't want more than like a 10% exposure to California real estate. So we just have to fill, if we were to take capital from them, we'd have a much smaller box to fill. So, it's clearly a problem. And the investors are the ones that are going to define, very specifically how much of a concern that is to them.
I mean, as I listen to you, it's remarkable. You're serving many masters here, right? You've got the consumer, you're certainly going to have regulators, and you have investors, and you have lots of different types of investors. The person that's going to buy the top tranches, the insurance company, will be very different than the people that are buy the riskier tranches. Mm-hmm. When you talk about what you just said there, that some of those investors are going to want to kind of parse out certain regions and things like that.
Yeah.
It becomes in some sense it becomes a very sort of complicated puzzle. No, it's definitely a complicated puzzle.
Yeah.
But sometimes complexity. There's a situation. If you with that kind of value add, you may ultimately be well compensated for that. I don't know if you can talk about it, but as you talk to investors, what kinds of return bogeys are they looking for, and what are you what are you giving them as a range? Is that something you can discuss?
Yeah, it's interesting.
Or is that the secret sauce?
No, it's interesting. And I personally think that there's a lot of gold in the complexity, because people that don't, this is a huge market, right? It's probably the largest asset class out there, right? So coming up with a complex solution in an asset class that is in the, trillions and trillions of dollars is worth the work associated with it. So I don't mind complexity. It doesn't bother me at all. I mean, it does not fare well for us, right, trying to raise capital from a venture investor. It is too complicated for venture investors, and I'm too old for venture investors anyway. So, but the strategic investors that see the value of this, particularly those that have distribution, the insurance companies, it's fine. Now, the really important question is the pricing on the product, and with interest rates moving up, the cost of equity is going to move up. So it's not dollar for dollar. You have to look at you can't just look at the, 250 or 300 basis point rise in interest rates as a guide to how much the equity cost should be, because that really needs to be a function of HPA, credit risk, stuff like that, right? So we do think that there'll be a relationship in the cost of equity to debt that right now it's much more narrow than it's ever been, because we haven't had any pricing impact, but we're going to in the next few months. And we think that, we'll probably go from a 9% IRR to the investor to probably something closer to a 10% IRR. But it's not going to be 200 or 300 basis points. And
sure.
It's the same problem that anyone's going to have. Interest rates entirely are going up, so I don't think we get singled out.
So for the benefit of our audience, when you say HPA, that's home price appreciation?
Yeah.
Got it. Okay. All right.
Yeah, exactly.
Well, this is a great conversation. I don't know, Ramsey, any other thoughts or questions? This is a very different take on a common problem people have.
Well, look, I grew up in a world of financial complexity, so I always find these things, very interesting. At the same time, I always, now in sort of my post-complex career, I also focus a lot on, well, how do you make it sort of palatable for the consumer? And I thought it was very interesting that you were very clear from the beginning that the distribution here is through someone like a financial advisor that can put it in, make it part of a menu and help a consumer, get to the right place. I think I agree with you that fundamentally that house value, being house poor, is like a big problem, especially in places like California, where you live. Mm-hmm. So people need solutions. People need solutions there, and so new and creative ones, I think, are great to have. And again, I keep on going through the formula in my head. I've got it now. Pretty sure I got it now. Anyway, good luck with your journey. It sounds like you've been at it for a while, and you're bringing another solution to the market, which is great.
Yeah, exactly. Well, thanks for having me.
Yeah. Well, David, thanks so much. And if people want to get in touch with you or learn more about the company, where should they go?
EquiFi.com is the easiest. It's a contraction of equity and finance. EquiFi.com. We're on LinkedIn. We're on Facebook. So easy to find.
Okay, good. We'll put that in the show notes. So, hey, listen, David, thanks so much. Ramsey, it was great. And for all the listeners, keep the feedback coming and join us again next week for another episode of That Annuity Show.